So after a day of romance with our profit and loss and balance sheet, let us now start dancing with them. Dancing with them is further going to fortify our understanding about profit and loss and balance sheet and use it for our own personal use. It's a great advantage to use this financial statement. It's going to help us understand our financial position today. And then eventually, by using this financial position today, we can use the frameworks to start propelling our path towards financial independence. So now let us share my screen. I prepared the initial prototype. This is the profit and loss prototype. And then you have the balance sheet prototype. So here under profit and loss, you have the income part here, and then you have the expense part. And in balance sheet, of course, you have the asset, and then you have the liabilities. So here I've kept two headers. That is credits. Credits in the sense company is getting inflow of cash. So the income is one stream where the company is going to get inflow of cash. And the other stream of inflow of cash is the liabilities. And then finally comes the debit, where company is going to remove capital from the bank balance by investing in assets or for purchasing raw materials, that is towards expenses. Now let us make a few entries. With respect to our own finances, our own personal finances, our income consists of two, active and passive as well, right? So active is our salary. Let us keep a note of it. Then passive will have like rental income, dividends, interest from FDs, if at all, maybe anything else we can add later. Then basic expenses would have like food, clothing. Let us say if we have a business, side business, so we can say purchase of raw materials. Because we have a business, a side business, we could also have product sale from business. This would be a side income, side hustle, right? So then when it comes to assets, long-term assets, we could have property, we could have stocks, we could have fixed deposits, we could have bonds, we could have many of other aspects, could have gold, and then we could have, under liabilities, we could have again property, because to take loan from the bank, property loan, then we have car loan, we have consumer loan. Okay, we have noted down a few items under credits as part of liabilities. Short-term liabilities, what would that be? Maybe short-term loan, short-term credit taken from a friend loan, friendly loan. Now that we have friendly loans, we are the owner of this company, right? So let's say we as owner have our initial capital invested into this company. This company, let us say it's XYZ wealth generation. And then we have short-term. Short-term could be bank balances in terms of cash. So this is a sample. So now let us say that we are starting this business. So to start this business, the owner would have an initial capital being invested. Let's say this initial capital is about 1 lakh. Remember that in accounting, there is two stages of transaction which we need to record at the same time. If we do a transaction under credit, we need to balance it equally under the same section of credit as a negative, or it could show as a positive under debit section. So we'll come to that understanding. Now that we know that the owner has an initial capital, which is 1 lakh, and this initial capital is a liability to the company, right? The company is expected to pay back to the owner, that's me, or to us. Now, because the owner has invested 1 lakh, which is a liability, it shows up into the bank balance as cash. So this will come up here as 1 lakh. So now you see, when I did an entry here, which is a positive under the credit section, I also did a corresponding entry in the debit section. If I had to do an entry in the credit section itself by removing from the debit, I would have to reflect it as a negative sign. So this is the two-way accounting philosophy. If you want to know more details about two stages of accounting, please drop a comment and I'll be glad to explain on that. So now for now, let us make an entry here. So our initial capital has been taken care of. Now you think, okay, we have an initial capital. Now what do we need? We want to buy assets. To buy assets, let's say, let's take a property loan. Property loan of 50,000. Would that be enough? It's a small business, so let's invest initially 50,000 and then see if the business does good. The public is appreciating us. Then we can further reinvest our profits, right? So this property loan becomes an initial investment of 50,000. Not investment. This is the loan taken from the bank, remember, and hence it is showing as the liabilities. Now, because I did one entry as a property loan on the liabilities, I need to balance it out somewhere. I need to balance it out in the debits under assets or under debits under expenses. What happens when you take property loan? When you take property loan, the bank gives you money, so hence it would appear as cash balance. So I add 50,000 here, right? So if I wouldn't add the cash balance here and I would have invested this cash balance to actually buy the property, then I would reflect it as a property asset worth 50,000. Now that I have shown it here on the assets, let us say this property asset is fetching me some rental income. In a year, a total rental income comes to around like 2,000 multiplied by 12. And this is the total rental income I get, for an example. So now because I'm getting this rental income under credit section of the income and the profit and loss, I need to balance it out again under debits. So because this is turning out to be an income, it will come under the cash register, which is of the equal amount, 24,000. Now I say, okay, I've got some income other than my active salary, which is nil. So now with this rental income, I decide, let me purchase some raw materials and do some business. Let me purchase raw materials, manufacture some goods, and then sell it in the market. So raw material cost me around 5,000, which is going to be part of the expense. And because now I have shown it as a raw material here, I need to adjust it somewhere. Now, if I adjust it somewhere, it's going to be either under credits, under profit and loss, under income, or it needs to be under credits, under liabilities. But as you know here, to get this 5,000, I need to take it out from the bank, right? So I need to adjust the cash register. So if I have to adjust cash register, I need to show it as a negative sign, because if I show it under the debit section of the financial statement, then I have to show it as a negative because it's already positive under a debit section as part of expenses. So now I've shown negative here. I have 5,000 reflected here. Now I say, great. So why don't I take a short-term loan from a friend to, buy some more raw materials? So I take this loan from a friend. I say 6,000. Because I've taken this loan, obviously it comes under liabilities. And I use this loan to buy raw materials. So credit adjusts it against debit. So another set of raw material I purchase for 6,000. So now with this total raw material which I have invested to manufacture goods, I sell them in the market and make income. So with that income, I have a net profit of say 20,000. And if this 20,000 is coming as a credit, I need to adjust it in the debit. If I adjust it in the debit, it's going to be a positive sign again. So, well, me as a owner, the business owner, I decide, okay, fine. Looks pretty good. I have sufficient cash flow. I have sufficient net worth as well now. There are a few things I need to take care of. Let me pay back my friend. Whatever I have taken earlier, let me pay it back. So I do an adjustment of minus 6,000. Now, because I did an adjustment of minus 6,000 under credits, I need to take the same amount, which is a negative sign itself, and show it under debit of cash. So I show it under cash debit. So here we go. And now let me say I've got sufficient cash flow. Let me buy some new clothes. So I again put some money here. I buy some new clothes worth 3,000 rupees. And because I have made an adjustment in the profit and loss under the expense section, I now have to adjust it under a credit or debit as part of asset or liabilities, or it could be as part of the income. Now, clothing is an expense, hence I have removed cash from the cash register. Hence I will need to show it under the debit section of assets. If I'm showing it in the corresponding debit section, hence I will show it as a negative sign. Very simple, is it? So we are enjoying our jazz with our profit and loss and balance sheet. It's so lovely, I must say. I mean, now let us say the concept that our balance sheet should be balanced, right? Our assets and liabilities should be same amount. We have our owner's capital, which is our actual equity. So the net worth will have to be added back to the liabilities to get the perfect balance. So we add it here, liabilities plus the net worth. And hence we see this is in a perfect balance with our assets. And we have a cash flow, enjoying cash flow every year on year. This cash flow on the net worth in the subsequent years, profit and loss and balance sheet. Where will that appear? This net worth is going to be appearing in our reserves and surplus as part of owners. Reserves and surplus. This will be showing up here in our next year's balance sheet. So I hope this is understandable. I hope you are able to prepare your own financial statements today. And if you have any doubt in preparing the financial statement, please do let me know. It's going to help us to start our journey from being financially insecure to moving into financial independence. To take a week's time, prepare all the items of income, expenses, assets, and liabilities, and be ready for our subsequent video how we need to control the most important element which any company does, that is our expenses. And then our second element is our converting our liabilities into assets. So please subscribe. Do not miss the next video, which is going to be your transformational journey as well. See you until then. Bye.